we're working with mostly farming communities in sub-Saharan Africa. In sub-Saharan Africa, 66% of adults don't have bank accounts, and that's most rural people don't either. So we help them get access to finance by measuring their commercial and financial activity, so they can access credit, and also using data to make markets more efficient so they get better prices for their crops. Many people in these communities don't have phones, and most are illiterate. So we have a community based around social and formal groups, so that everyone can get an ID, a wallet, and a digital history, even if they don't have a phone. And that's, I think, one of our key innovations, even though we're using very advanced technology. And there's a huge opportunity in the agricultural sector because 70% of African arable land is unused. So actually giving these farmers access to small investments can really increase yields by 3 times or more. And of course, we're all going to need more food in the future, and Africa is a great place to grow more food. Absolutely, yes. I mean, especially where there is limited financial infrastructure. As you get in many developing economies, often the financial infrastructure doesn't really reach outside the towns very much. And blockchain is infrastructure, and that means it's part of the solution, it's not the whole solution. But as we're showing, it can help to build the bridges that people need to save and access growth capital for businesses. And we're using stable coins, which are denominated in local currency. So that can give people access to cheap digital payments in their own currency without needing a bank account. And that's a real differentiator, even in places where there is mobile money, which tends to be quite expensive. But more importantly, it really helps them to save and build wealth without being tied to a financial institution. So yes. Yes, I think they are part of the future of money. Again, there's no single future for any of us. And we were writing about this in my last book, which was published in 2018. So it's taken quite a long time to get here. But I think that CBDCs, central bank digital currencies, will be a big part of the future economy. Although there are some economic implications that are still being worked out, and a lot of debate about what models to use, because it's such a big change that people are really not sure what's going to happen as a result of it. But it does look inevitable. I mean, if you look at the scale of the e-yuan pilots that have been happening in China, they've been running with hundreds of thousands of customers. Other countries have already started launching theirs. Many are already using CBDCs for wholesale settlements, so for commercial settlements without having a retail CBDC, including countries like Canada and Australia. And the US and the European Union are both looking at issuing their own in a few years' time. So I definitely think it's going to happen. Today we've already got the sand dollar, we've got the e-yuan in such a big pilot that it's almost a live rollout now. Eastern Caribbean has also issued theirs. And then we've got countries with lots of pilots going on, such as Sweden, and other developing countries which are actually issuing them faster. The Marshall Islands issued theirs a while back, but actually got shut down because the model wasn't very good. But many developing economies are looking at China and the US and thinking we've got to get on with it, because otherwise our economy is going to be impacted by these, by a flood of foreign stable assets, which our population will want to have. So, from a developing economy perspective, I think it's a really critical part of what's going to happen, and it's going to be hugely impactful to their economies. Cryptocurrency is the native digital asset that sits on a blockchain. And as we all know from looking at Bitcoin and Ether, they are by nature volatile because their value is determined by the market. And that market often has a lot of interested parties, shall we say, who are pushing the price up, pushing it down, and it's highly volatile. A stable coin is a digital asset that is built over a blockchain, which has a relationship to the core asset, but is programmatically stabilized to keep pegged to the local currency or a currency. So, for example, in our application, our stablecoin just tracks whatever the local currency is, which means that you're not introducing volatility into financial systems. And obviously, that's something that central banks like. A central bank digital currency, however, is a particular type of stablecoin asset that is issued by a central bank. So in many respects, you could say it's not really a blockchain asset at all, because it's centralized. And one of the key things about blockchains is they are decentralized. But the key thing about a central bank digital currency is that central banks have the opportunity to implement monetary policy through these assets in a way that it's very difficult to do with cash. So that is one of the most transformational things about it. And the other one is the financial inclusion. Because in effect, depending on the design, anyone who can hold cash can, in theory, hold a central bank digital currency with or without a bank account. So there's a sort of sliding scale between the three. I would say the main difference between CBDCs and stablecoins is that stablecoins are privately issued assets. They can be issued by banks or by people like us, whereas central bank digital currencies are issued by central banks. Small businesses have a big problem with trust. And that means that they can't get access to capital. And when I was working in banking and building international banks, one of the big problems for banks is actually assessing risk for small businesses, because it is complicated, and you have to do pretty much the same checks for a small business as you would for a big corporation. So the unit economics just don't work for banks, and that's one of the reasons that small businesses really fail to get access to capital from banks. And it's all about trust. So I think one of the opportunities that blockchain brings is this ability to build indelible records about a business's financial and commercial performance, which can be trusted. So, one of the big risks of lending to small businesses is that, a small business like a builder might be going around to multiple stores asking for lines of credit from all of them, and there's no way they can cross-check against the other stores. But if their records are on the blockchain, then everyone can see them, they're transparent, and with the right access, people can get the information they need to make good credit decisions and therefore to lend to small businesses. So I think that's one of the most important ones. And the other side, of course, is the market side, where blockchain can help with things like micropayments, with getting access to different kinds of customers, and with distributing investment as well. So one of the examples we've seen recently is the securitization of equity and bonds, so that you can fractionalize capital investment into small businesses. And everyone can be an investor in a small business, because you don't have the big barriers of having to be a high-level equity investor or big government bond investor, because you can fractionalize the assets into very small denominations of $1 or $10. So more people can invest, which also is good for small businesses. Big companies are already using blockchain to make their systems more efficient and to make their financial systems in particular more efficient. But there's a great deal more they can do. And one of the things I think the companies are not yet doing effectively is exploiting the decentralization opportunities. When you're running a walled garden application, you're actually not getting the main benefits of blockchain, which are the ability to have these public trustless records. So public assets like self-sovereign identity, traceability of goods and services can be a huge benefit to big business, but also to sectors. And if you think about, for example, the amount of fraud that you get in trade finance, those sort of use cases are absolutely ideal for blockchain. And you see quite a lot of it out there. For example, in trade finance, a shipper could just issue 6 bills of lading and get credit from 6 different banks. Whereas, of course, if it's on the blockchain and everyone can see it and it's transparent. And the same applies to things like land registry. In Africa, there's a huge amount of land registry fraud. And again, having those assets on the blockchain means that the banks can all see the true record. So obviously it does make internal processes more efficient, but so does any well-designed technology. And the key benefits that can be realized is actually by publicly available records, which can be shared by an industry. Blockchain is great for tracing value chains. And I think one of the things I've seen in ESG reporting from major corporations is that the value chain tends to stop outside the walls of the core headquarters business. And what we're seeing is, for example, companies like mobile phone companies and other manufacturing companies have got very complex supply chains going all the way to, mining in DR Congo, where you've got child miners digging up cobalt. So blockchain can provide traceability for raw materials, for suppliers throughout a supply chain, and actually give confidence to that company that your supply chain is clean. And we see a lot of traceability applications of blockchain, which are already in the market and can be used. So I think from a sustainability perspective, it's something that many companies are not actually able to say really with the hand on their heart. I'm confident that my supply chain is clean, that it's sustainable, and blockchain can really help to do that. So from my perspective, that's one of the most important uses from a green and sustainability perspective. And it can also help to obviously trace the financial aspects. So for example, we can actually tell a big company how much the farmers are getting paid for their crops. And most big buyers cannot do that today. Even through fair trade, it's just not traceable. So one of my key targets this year is to finish my next book, which is about microeconomics, community finance, and how technology is enabling these new paradigms in the distributed economy. But from a business perspective, we've also got rollouts coming on in Nigeria, Kenya, and potentially some other countries. And we're also seeing a lot more demand to tokenize different types of assets. Vouchers is a big thing in the NGO sector, and we're using that a lot. But also vouchers being used as a credit allocation to allocate goods and services without the risk of moving money around. And that's a very interesting use of blockchain, I think. And then, yes, just carry on onboarding more customers in Mozambique, Zambia, and Uganda, where we've already got rollouts going on. Although I spoke to someone this morning in Rwanda, so maybe we'll be there as well.